What's up, guys? I'm gonna let everybody join this feed. Okay, I'm gonna let everybody join this feed. Please share this feed, start swiping, and let's share this feed with everybody on Periscope, Facebook, and Twitter. All right, I can see when you share, so please share. All right, I can see when you're sharing, guys. So let's get everyone to share. All right, let's get everybody to share this. Okay, I'm spending my Friday night for you guys, so I'll let everyone join the feed. I'll let everybody join the feed here. All right. Let's see if we can get this to over 1,000 people. Let's see if we can get over 1,000 people in here. Just hold on, I'll be right back. All right, guys. Let's share the feed. Let's share the feed. Let me get a drink for myself. All right. Still don't have 1,000 people in here? Okay, we're gonna be starting soon. All right, how's everybody doing, guys? Hope you guys are having a great evening. I hope you're having a good night. I know it is a Friday night. A lot of people are probably out. And I want to put on a little lesson because I found that there's been a lot of traders that have been making this common mistake. And essentially, I want to prevent them from losing any money in the future, regardless of which trading group they're with or where they're affiliated or associated. So prior to starting, let me introduce myself, guys. My name is Reza Mokhtarian. I'm 33 years old. I'm a venture capitalist. I'm an angel investor. I am a Forex trader and the founder of MentorTips.com. I came to Canada in 1989 in the back of a pickup truck with my family. We fled Iran, and fast forward 26 years later, and I've amassed a $25 million plus empire, trading the financial markets and running multiple companies. And now I'm a widely followed mentor on social media, and I have my own company as well, MentorTips.com, amongst a lot of other companies that I fund and I build and develop. All right. So anyways, guys, let's keep this entire thing positive. Let's please focus on positivity. Let's not bring any negativity into this. All right, Mentor Tips has not been down at all. We were just doing some kind of updates on the server. Everything is great with Mentor Tips. My company is MentorTips.com. I'm the mentor of that business, and I have about 3,500 students that I mentor on a daily basis. And today I want to talk to you guys about the Forex industry, all right? I want to talk to you about what made me wealthy, what brought money into my life, what initially taught me the lessons I know now to generate the wealth that I have. What is a Forex industry, you may ask? Well, Forex stands for foreign exchange. It's the exchange of one currency to another, all right? Essentially, it's identical to the stock market where you buy low and sell high, all right? Or vice versa. You're exchanging one currency for another, and currencies appreciate and depreciate due to multiple different factors: geopolitical factors, global economical crisis, or interest rate statements, technical analysis, etc., etc. But you have the ability to make thousands and thousands of dollars per week trading this unique market. And it's a market that I participate in, and it's a market that I teach individuals like yourself every single day how to be successful in. Now, today we're going to talk about something related to the Forex markets. We're not going to do a beginner's course. We're actually going to get into a strategy that a lot of traders are using and they're employing in their day-to-day routines, all right? And it's costing them money. It can cost you money. It can make you money, it can cost you money. And I want to give you a little example and show you essentially what this is, all right? I'm going to go and erase this. This is my information. So my Instagram is @OceanSky with 2 N's, OCEANNSKY. My Twitter is RealOceanSky, RealOceansky. Please go ahead and add me so we can continue to stay in touch and further work together, etc., etc. So today I want to teach you guys a valuable lesson that is going to save you a tremendous amount of money. A tremendous amount of money, all right? Now, just to let you know, if you like what you see tonight, if you enjoy this, and if you want to change your life as well amongst all my other students, all right, I do have a program I offer that teaches you everything you need to know about this. And I'll tell you exactly how to enroll in it, because it's an invite-only program which only costs $97 a month, and you essentially have the opportunity to make thousands of dollars per week by simply sending an email to joinmentortips@gmail.com and saying I want in. All right. Again, just to let you know the email again, it's joinmentortips@gmail.com, and if the fellow individuals here want to go ahead and write it down so everyone else has it. You can see everyone is bragging about the program that they're in, and others can send an email if they're interested in this in my program, and I can sign them up. Again, it's invite only. All right. So let's talk about the Forex market. So I'm going to draw for you a conventional chart. All right. Now we trade on platforms. All right. Excuse me. I'm using a color that is not particularly a good color on the eyes, nor are you able to really make that out. So let's actually go ahead and bring this a little bit closer. All right, let's go ahead and bring this a little bit closer. And let's go ahead and draw a chart here. All right, this is essentially a chart. All right. Again, I'm terribly sorry if there's too much light. And I'm doing my best here with what I have on Periscope. All right. This is our chart. All right. Now, a chart has two areas. On the right-hand side, going vertically, and on the bottom, you have figures going horizontally. All right. On the right-hand side, this section is essentially your price levels. All right. These are your price levels. On the bottom, you have the intervals, time intervals. Okay. Now, I'm not going to write the time intervals in or the price levels because at this point it's irrelevant. We'd like to discuss something a lot more powerful than that. All right. So let me go ahead and actually bring this a little bit closer for you, because we don't really care about my face. We want to see this. Is that better, guys? I'm sure that's a lot better, right? I'm gonna go ahead and hide this chat room as well. Please, guys, give me as many hearts as possible. I'm doing this for free on a Friday for you guys. Please go ahead and give me as many hearts as possible and share this feed with as many people as possible. Let's get over 1,000 people in here. Now, when we trade conventionally, we trade on a chart, a Forex chart that is very similar to what you would see on a conventional stock chart. All right, so you get price that goes up and down. You know, price moves in multiple directions, and you know, we go ahead and we take our trades based on movement of price. For example, we can buy over here and hold the position until it comes over here, sell, get rid of the position, and all of this movement here we have taken as a profit. Furthermore, we can actually go and sell the position here and buy it down here, which essentially means we are exchanging one currency for another and banking that the pair is going to be, for example, if we sell the Euro USD, we are buying the US dollar and saying the US dollar is going to advance against the Euro, and we're going to release the position here and again, take all the profits. Now, the one thing that is wonderful about the Forex markets is you can make money when the markets are going up. You can make money when the markets are coming down. As opposed to what others call in the stock market a crash. You know, in the stock market, you get times where they say a stock market crash, the markets are going down. That essentially means individuals who have invested are losing money. But with the stock market, irrespective of the market going up or the market coming down, we can make profits going up, all right? And we can make profits going down. It doesn't matter which direction we take it in, we can make profits on any way we want, all right? Whether the prices are going upwards or whether the prices are coming downwards, we can make a healthy profit. Now, there's something else that is quite important, risk management. In fact, risk management is one of the most important aspects of any business, be it investing in the financial markets, real estate, owning a restaurant, or any other type of business where an investment is involved. Any business, in fact, irrespective of its niche or its category, requires some sort of investment. So prior to making an investment, one would require ample risk management by performing their due diligence. Due diligence is key. By performing due diligence, you get the chance to essentially understand exactly what you're getting yourself into. And if the risk ratio and reward ratio is lucrative. Because your risk to reward ratio should always be to your benefit. All right? Should always be to your benefit. In fact, if you risk $1, you should be getting at least $4. That is my take. For every $1 I risk, I want to earn $4. That means if I lose $1 twice and win once, I'm still up by $2. So my profit consistently goes up. I'm sorry about the chicken scratch here. All right. So I make sure my risk to reward ratio is always profitable and lucrative for me. And I do that by performing my proper due diligence on any sort of business that I get into. Now, how does risk management and due diligence tie into the financial markets? Well, very simple. Every single time you execute a trade, when you decide to buy over here, all right, you're always facing the possibility that the market might actually turn against you and go downwards. Now, should the market turn against you, you start losing money. Now, your money doesn't get lost until you close that executed position, but you start going into something called a drawdown. Now, a drawdown is when your capital is depreciating due to the fact that the instrument you're holding in the specific financial field, be it stocks or currencies, is depreciating. So once that instrument starts to depreciate, if you've bought it, you start incurring something called drawdowns. Now, drawdowns are very normal. In fact, the moment you open up a trade, the instant you open up any trade in any specific market, you immediately enter yourself into a drawdown. All right? Now, every time you open a trade, you pay commissions. All right? Or a specific percentage of the spread. And that is how brokers make their money. Other than brokers who are market makers, but that's an entirely different lesson on its own. Now, you either pay comms or a percentage of the spread. And that's what the broker charges to broker the deal, because they have to get paid, right? So every single time you buy, all right, if, for example, prices are going up and you buy right here, your buy price, your strike price might actually execute over here because the broker made that difference off of you. So the moment, yes, correct. All right. So the moment you execute that trade, you're already in a little bit of a drawdown. All right. It's opposite way around. I'm sorry. All right. You're already in a drawdown. Okay. That's the comms or the spread. And the drawdowns are normal. Now, should you also execute a position here, there's a possibility prices may start to come down against you. And this is where things get tricky. All right. As a venture capitalist and an investor, I always tell my clients and my students, all right, that capital preservation, all right, capital preservation is greater than capital generation. See, it's one thing to be able to generate capital. It's another thing to be able to maintain that capital. If you make $1,000 a day but bleed away $1,100, you're net negative $100 every single day, which means you're not really in a lucrative position. All right. In fact, in a business level, fundamentally, you're making some drastic mistakes. You want to be in a position where anything you're generating, you're also preserving at the maximum percentage, which is your retention ratio. All right? It's your retention ratio and your retention percentage. All right? I don't know if this formula really exists. I kind of made them all up myself in my own head. I'm not sure if it exists, but I have a formula I've created for this that I'll give to you guys at another time because I don't want to get into that. But essentially, capital generation, all right, is the first step. But the most important factor is capital preservation, and you get a retention ratio out of that. Now, the higher your retention ratio, all right, the better you're doing in business and the better your business will succeed. So again, how does this tie into trading the Forex markets? Well, very simple. Every single time you execute a trade, you got to protect your downside and make sure you don't lose money. So let's say the markets are going up here. And we've done all of our due diligence and technical analysis, and we've realized that we should buy this specific pair. I would go ahead and draw my support level. And I would say, well, this is support. It's broken this level. When prices come back here, I'm going to buy over here and I'm going to target here. So I'm saying that prices are going to pull back. I'm going to buy over here and I'm going to target up here. And I'm going to make all of this profit. But what happens if I'm wrong? What happens? Do I not have to protect my downside? I cannot be right 99% of the time. In fact, no trader is. Other than a guy with the initials OC. OS. All right? Now, if prices fail to hold this level, should prices fail to hold this level, prices are going to slowly drift past and below my entry point. And it's going to put me into that word that starts with a D. Drawdown. All right? And my account is going to start going into a negative balance. Now, if I continue to hold this trade forever, eventually, my account is not going to be able to sustain the downside movement of this, and my account is going to get wiped out. I'm going to lose all my money by suffering a tragic fate called a margin call. All right? It is the red bar of death on MetaTrader 4. When your account gets a margin call, there's not sufficient funds to facilitate the trade you're in, therefore the trade liquidates. All right? So how do you protect yourself in the event that you take a trade and your trade starts going against you? Well, traders have something called a stop loss. All right? A stop loss is a predetermined area on the chart that you choose or select after making your trade to essentially say, if prices reach these levels, automatically close my position. So for example, if I go ahead and buy this pair right around here, let's say this is the euro and I buy it here, I can see that the next level of support is here and say, well, if prices come to this level, automatically close my order. So if I bought here and prices start to drift lower and lower and lower and lower and hit this level, my trade automatically closes out, and although I do lose on that trade, I essentially live to fight tomorrow and bring my account back up. You see, it doesn't matter whether you win or lose on a trade. What matters is that your equity curve continuously and consistently rises. You can see here, even in this picture, winning day, losing day, winning day, losing day, winning day, losing day, winning day. Although every single winning day is preceded by a losing day, you can see that the equity curve continues to rise, which means my net worth within that specific portfolio is appreciating. So that's okay. Now, a lot of traders have a psychological issue where they absolutely think every single trade should win, and they're afraid to close a losing position. So they do something that we traders call marrying your trade. They become emotionally attached to that position. And they keep holding it in the hopes that this trade is going to come back up to their initial entry and they're going to get their money back at a break even. In fact, when they originally take the trade, okay, they really wanted to go way up here. All right. But as it's falling down against them, they're so scared now, they're going to pray that it just goes back to the original entry. You understand? Just so they can get their money back. But the thing is, when it does go back to its entry and they said, I promise I'm going to take the profits now. I promise I'm going to take the profits now. God, please take it back here. When it does go back, it's like, nah, let me hold it a bit longer. They become greedy until it goes down against them again. And when it doesn't come all the way back up there, when it goes way down here, they keep saying, God, just bring it back up to this drawdown. Let me just take a 10% loss. I promise you bring it back up here and I'll take my loss right now. Well, surely when it comes back up here, they don't take the loss because they say, well, it's going to go right back up to break even until it goes down even more. And they find themselves in a position where had they put a stop loss right here initially, yes, they would have lost on this trade, but they would have taken a very minimal loss, not a significant loss. They would have taken such a minimal loss that on their next trade, they could have doubled back the losses and then some. But because they married the trade and their psychological disorder of being greedy got to them, and they kept saying, well, if, and they never close, they continue to drift lower and lower and lower until all of their money is gone. All right? And this is the common killer amongst Forex traders. If there was a common disease that affected all Forex and market analysts, it's this. It's marrying your trade and being greedy. Because the two major characteristics that you want to avoid in any business is fear and greed. These two common characteristics that we all share are the driving factors of failure in any kind of business. Every business model that has ever failed has failed due to one of these components. You either fear investing or fear getting your feet wet, therefore you never expose your potential, or you become so greedy that you over leverage yourself and lose everything anyways. So it's that greed that causes a trader to marry his position and ultimately come to his demise. Now, what is the strategy that I want to discuss tonight that a lot of traders are employing into their system that is causing them to fail? Well, this is what it's called. And a lot of you probably didn't even know this is what it's called. But you do it every single day. It's called martingale trading. All right, it's called the martingale strategy. Now, what is a martingale strategy, you may ask? Well, it's a strategy that if employed once in a blue moon and you have a little bit of luck on your side, can actually make you money. Now, I'm going to allow you guys to write that down while I get myself a quick drink. My throat's getting a bit dry. Now, every trader does this. In fact, I started doing it when I first started trading. And you know what? It made me money till it wiped me out completely. Now, what is it exactly and why do traders do it? Well, the martingale strategy is essentially all tied into the whole marrying your trade. You see, when a trade is going upwards and the individual goes and buys right here and the trade starts coming downwards, well, he should have a stop loss right here. This should be your stop loss. So should the trade drop to this level, hey, he closes it, he gets a small loss, a loss that he can make back tomorrow and be back on his road to success. However, what traders have started doing is this. Let's say they bought one lot over here, okay? One lot is equivalent to $100,000 of currency, which with leverage of 200 to 1, which a lot of traders use, costs you $500. All right. Every pip that goes up in one lot, so every tick that you make is equivalent to $10. Now, they take this position here. All right. And they're banking for prices to rise. Now, what happens? Prices start to come down against them. All right. What they should be doing is closing the trade. A poor trader continues to hold this trade until it continues to go into a worse drawdown. But what these martingale traders are doing, and they're not doing it because they don't right from wrong. Terrible traders that think they're analysts are teaching this. And this is the most amateur way of trading and the worst way of trading. There's two terrible ways of trading. Tonight you're getting one lesson. Tomorrow night you're going to get another. Now, with this martingale strategy, what they start doing is this. Once prices have gone against them, guys, share the feed again. I want everyone to share the feed right now one more time because I really want everyone to enjoy this. I want everyone to get this, guys. Come on. All right. What happens is instead of closing their trade or just being a bad trader and letting it continue to go against them, which is bad enough, they continue to add to their position. So if they bought here, as it drops, they buy one more lot again. They buy here again. Because they're hoping that it's going to turn around from here and go up. So by the time they're back up to their original entry, they've made all of this money. And they can actually close this position and close this one at a break-even point. All right? And they made all of this money. Now, sometimes they get very lucky and right from the next support level, it goes up and they're superheroes. In fact, you may get lucky 20 times in a row. Essentially, what you're doing is feeding a dying position. You see, if you got a business that's not making money and it's bleeding money and it's not lucrative, would you continue to invest into it or would you let it go? The intelligent businessman would let it go. He would never continue to invest in a business that's not lucrative. So if you got a position that's not lucrative and hitting a stop loss area, why would you dump more money into it? So what they do is they buy it again. But what happens? It continues to drop. Now they're down double the money. They're losing money at a higher pace. So it comes down here, they buy again. Now they're in so deep into this trade that they have forced themselves to marry this. It's now all or nothing. Now, if this trade decides, hey, I'm not going to come back up, guess where it's going to go? In fact, common sense and technical analysis states, once your entry has been broken by two different support levels, it is not going back up. There's probably a sentiment shift. The sentiment has probably gone from bullish to bearish. So why are you even counter trend trading? You should know better. So it continues.